So imagine a stock that plunges 20% right after earnings. It flashes all these glaring warning signs, and then suddenly, seemingly out of nowhere, it surges nearly 9% in a single day.
Right, which is just a massive violent swing.
Exactly. So the question is, are we looking at a textbook falling knife waiting to trap you, or, a fiercely undervalued opportunity that the broader market is just starting to wake up to?
I mean, it really is the ultimate puzzle for anyone trying to navigate market volatility right now, because you have these massive swings in price action and, well, the surface level data is pulling the narrative in two completely different directions.
It really depends on which line of the income statement you happen to be looking at.
Oh, absolutely.
And before we tear into the mechanics of this particular roller coaster, make sure you hit that like button, subscribe to our YouTube channel, and leave your compulsory feedback in the comments. I mean, we really want to know if you are buying or shorting the setup we are about to unpack today.
Yeah, because today's deep dive is, honestly, it's incredibly complex. Our mission here is to synthesize a pretty massive stack of real-time market data, technical charts, and financial reports from today, April 17th, 2026.
Right, and we are putting TransMedics Group, Inc., ticker symbol TMDX, firmly under the microscope.
And just to set the ground rules right out of the gate, what we're doing here is having a natural human debate about market signals and the underlying economics of this company.
Yeah, exactly. We are analyzing the sources, the conflicting models, the data you shared with us. This is strictly educational.
Right. It is not financial advice, and we are definitely not telling you how to manage your portfolio.
Nope, you're in the driver's seat for that.
Yeah.
We just want to synthesize these dense reports so you can see the broader picture.
Yeah.
So to figure out if this recent surge is like a genuine reversal or a localized trap, we have to start by looking under the hood at the company's financial engine.
Right, because the whiplash on this specific ticker is just intense. I mean, look at where TransMedics is sitting as of today.
Yeah, we're looking at a massive bullish reversal on the daily chart. The stock is up 8.84% on the session, trading right at $118.77.
Which is a daily gain of almost $10.
Right. But you have to zoom out to see the real volatility here. They recently ate a 20% decline post-earnings. And their 52-week range is incredibly wide, stretching from a floor of $86.14 all the way up to $156.
And, that 52-week range tells you pretty much everything you need to know about the institutional confusion surrounding this stock.
Oh, for sure.
Because a 20% drop after an earnings report, well, usually that implies a fundamental breakdown in the core business. You'd expect to see collapsing margins or, I don't know, completely missed revenue targets.
But the source material for their fiscal year 2025 financials paints a completely different picture. It's almost paradoxical.
It really is.
And that's the disconnect that really caught my eye. I'm looking at the income statement for FY 2025, and TransMedics reported record revenue of $605.5 million.
Yeah, which is a 37% year-over-year top-line growth rate.
That's huge. And the net income looks stellar on paper, right? $190.3 million, giving them a diluted EPS of $4.87.
Right, and if you just run a basic algorithmic screener, this stock looks like an absolute juggernaut.
Exactly. And that is exactly how algorithmic trading bots read the tape. They scrape that $4.87 EPS, calculate a shockingly low price-to-earnings ratio for a growth stock, and they just start buying.
But, and this is the big but, this is where you have to look at the actual mechanism of that net income. Because included in that $190 million is a massive one-time $82.8 million tax benefit.
Okay, let's unpack this, because this drives me crazy.
I know, it's a huge caveat.
Right. Earning $190 million sounds incredible to the retail market, but almost half of that is a one-time accounting adjustment. It's like boasting that your annual salary doubled because, you found a winning lottery ticket in your coat pocket.
That is a great way to put it.
So how much of this supposed financial strength is actually recurring operational business?
And that is the crucial distinction you have to make. A tax benefit, whether it's from deferred tax assets or previous operating loss carry-forwards, that's a balance sheet reality. It's not an operational one.
Right. It doesn't mean they actually sold $82 million more in organ transport services.
Exactly. It just means the accounting department had a very good year.
Yeah.
When you strip that tax benefit out, the net income looks far more pedestrian.
So to find the actual pulse of the business, you have to basically bypass the income statement entirely and look at the cash flow statement.
Yes, because net income is an opinion, but cash flow is a fact.
I love that. So what is the operational cash flow actually telling us here?
Well, it is actually telling a very bullish story, surprisingly. In 2025, TransMedics achieved its first full year of positive operating cash flow, bringing in $192.8 million.
Wait, really? Almost 200 million in actual cash.
Yeah, that is the tangible cash generated by their day-to-day operations, like their organ care system consoles, their single-use disposable sets, their logistics network.
And that 192 million is totally separate from the tax benefit magic we just talked about.
Completely separate.
Wow, okay, that changes the narrative significantly. Because if they are pulling in hard operational cash like that, they aren't just burning venture capital anymore, they actually have a self-sustaining engine.
They do, and you can see it reflected on the balance sheet, too. They are currently sitting on about $1.07 billion in total assets against just $595.3 million in total liabilities.
So the assets are nearly double the liabilities.
Exactly. Yeah. And more importantly, their liquidity is strengthening. Their cash and cash equivalents grew from $466 million at the end of the third quarter to $488.4 million by the end of the fiscal year.
So the core engine is generating real cash, and the war chest is growing. But, I mean, if the foundational business is undeniably strengthening, why did the stock get absolutely hammered down to the $86 mark before this recent bounce?
Well, the market clearly isn't buying the pure bull narrative.
Right. There's always a catch.
There is. The market is incredibly conflicted because of the macro environment they operate in, which we will get to in a moment. But first, we need to see how this fundamental conflict is manifesting on the charts.
Yeah, let's look at the technicals. Because the financial data shows this weird mix of genuine cash flow and one-time accounting noise, and the technicals show exactly how traders are trying to price in that confusion.
Honestly, looking at these technical charts, the pape is showing a massive tug of war.
It really is. I'm looking at the momentum indicators, and the setup is fascinating. I mean, over the last 7 days, we've seen a 13.2% gain, and today's 9% surge seems to be confirming a short-term bullish reversal.
The short-term momentum is definitely shifting. If we look at the RSI, the Relative Strength Index, it's hovering around 31.75.
Which means the aggressive, panicked selling pressure that drove it down after earnings has essentially exhausted itself, right?
Exactly. The rubber band was stretched as far into oversold territory as it could go without snapping. And now we are seeing the natural reversion to the mean.
Okay, but RSI alone doesn't dictate a trend reversal. It just tells you the immediate velocity of the selling has paused.
Right, which is why we have to look at the MACD. The MACD is giving us a much clearer mechanical signal right now. The histogram is flattening out, and the metric has improved from negative 9.22 to negative 0.83.
So the gap between the short-term and long-term averages is aggressively closing. It's like, if you think of it like a car's momentum, the car might still technically be rolling backward down the hill, but the driver has taken their foot off the gas and is finally starting to apply the brakes.
That is a perfect way to visualize it.
Yeah.
And we saw the buyers actually step in and defend the price right at that $100 to $109 support level.
Yeah, even when macro selling pressure spiked across the broader market in late March, that floor held firm.
It did. And if this upward momentum continues, the next real tests, the resistance ceilings where institutional sellers are likely waiting, those sit at $126 and $145.50.
Okay, but here's where it gets really interesting, and frankly, a bit dangerous for the everyday investor. The moving averages are flashing a massive structural warning sign.
Oh, absolutely they are.
Yes, the stock crossed above the 5-day EMA today, which explains the 9% intraday pop. But it is still trapped below the 50-day, the 100-day, and the 200-day simple moving averages.
And that is the crux of the technical bear case right there. The trading below the 200-day moving average means the overarching long-term institutional trend is still definitively downward.
The massive funds that move the market are still structurally bearish on this stock.
Exactly.
So isn't this exactly the kind of technical cross-current that just butchers retail traders?
Of course, 100%.
They pull up their brokerage app, they see an 8.8% green daily candle, and the fear of missing out just instantly kicks in. They look at the 52-week high of 156, they look at the current price of 118, and they think, wow, I'm buying a guaranteed 30% discount.
It is the textbook retail trap. Retail traders frequently mistake a short-term short squeeze or a little technical bounce for a long-term macroeconomic reversal.
They just buy the pop above the 5-day average.
Right. But because the stock is chained below that massive 200-day moving average, the institutional algorithmic sellers are just waiting at those higher resistance levels.
So the retail buying pressure exhausts itself at, say, 126.
Yep. And then the institutions step in to short the resistance, and the stock rolls right back over, trapping the retail trader at a localized top.
It's brutal. It's like swimming toward the surface because you see a patch of sunlight, completely unaware that the macro current is still pulling you out to sea.
That's exactly what it feels like, and the charts are incredibly conflicted. But when you look at the valuation models, I mean, the quants can't agree on reality either.
The divergence in the valuation models is honestly staggering. Depending on which automated discounted cash flow model you look at, TransMedics is either the bargain of the decade or a catastrophic value trap.
Yeah, let's look at Simply Walsent. According to their model, the stock is currently 38.3% undervalued. They spit out a fair value estimate of $184.81.
That is a massive premium from the 118 it's trading at today.
Yeah.
But then I pull up the alpha spread data, and their DCF model slaps an $87.88 intrinsic value on the stock. They conclude it is 24% overvalued right now.
It's wild.
How is it mathematically possible for two institutional-grade models using the exact same SEC filings to be $100 apart on fair value?
Well, it all comes down to the terminal value assumptions built into those models and how they handle the mechanics we discussed earlier. Simply Walsent is likely taking that 37% year-over-year revenue growth and just aggressively extrapolating it into the future.
So they are assuming TransMedics scales its monopoly without any margin compression at all.
Exactly. Alpha spread, on the other hand, is likely stripping out that $82 million tax benefit, looking at the inherent capital expenditure risks, and applying a much harsher discount rate to account for the volatility of their logistics network.
It really just highlights that DCF models aren't crystal balls. They are just mirrors reflecting the bias of the analyst who built them.
Yep. If you assume infinite high margin growth, you get 184. If you assume heavy capex and macro headwinds, you get 87.
And when the math is this divided, you have to look at what the people who actually run the business are doing with their own money. And the insider trading activity over the last 6 months is just wild.
It's wildly hypocritical, is what it is.
Look at the timeline. Late in 2025, near the bottom of a previous dip, the CEO buys roughly $3 million in company stock on the open market.
Which is a massive vote of confidence. Usually, when the CEO backs up the truck, the bottom is in.
And institutional investors generally mirrored that confidence, right? They largely held their positions through the recent volatility with only some minor reductions in March.
Right. But then you have to look at the actions of the board.
Exactly. In early March 2026, while the CEO is holding his shares, several directors dumped a combined $2.4 million in stock.
Right at prices ranging between $140 and $150.
So what does this all mean? The CEO buys the bottom, but the directors are aggressively cashing out at the top. If the people running the company are just swing trading its volatility, aren't those glaring negative signals?
It definitely forces you to question the internal alignment. Now, director selling can happen for a multitude of reasons that have nothing to do with fundamental weakness, to be fair.
Like what?
Well, they could be paying tax obligations, diversifying a concentrated portfolio, or, funding a real estate purchase.
Sure, I get that. But the timing is just impeccable. They sold at 140 to 150 right before the stock plunged 20% down toward the $100 support level. You simply cannot ignore that.
You absolutely shouldn't ignore it. Even if the sales were pre-planned through 10b5-1 programs, it indicates that at $150, those directors believed the stock was fully valued, or at least valued highly enough that the risk-to-reward ratio favored taking millions of dollars off the table.
And the broader analyst community seems to agree with that exact $150 ceiling. I'm looking at the consensus ratings, and it's currently a moderate buy. The average price target from Wall Street analysts is sitting right at $152.33.
Which perfectly aligns with the resistance zones where the directors were unloading shares.
Exactly. For the short-term outlook, analysts expect the current momentum to carry the price back to around $127 by late April.
But the long-term forecasts are where you see the real bullish optimism. Some analysts are actually predicting a price target of $246.71 by the end of 2026.
But ultimately, whether the stock collapses through that $87 alpha spread trapdoor or rockets to the 246 long-term target isn't going to be decided by a MACD convergence or an insider sale.
No, it comes down to the real-world business operations. They have to execute in the real economy.
And that is the core of this entire debate. If we step away from the tape and connect this to the fundamental mechanics of the business, TransMedics offers a compelling yet incredibly capital-intensive narrative.
Yeah. Let's talk about the best-case recovery scenario, the bull case. It centers entirely on their technological moat.
Let's talk about that moat, because their organ care system, or OCS, is fundamentally changing transplant medicine. I mean, historically, an organ is placed in a static, cold storage cooler.
Yeah, it's essentially just put on ice.
Which gives you a very narrow window of time before the tissue degrades and the organ becomes unviable.
Exactly. Cold storage limits the geographic radius for a transplant. But TransMedics OCS technology keeps the organ, whether it's a heart, lung, or liver, it keeps it in a living, functioning, and medically optimized state during transport.
So the heart is literally beating inside the machine.
Yes. This dramatically extends the time an organ can be outside the body, which obviously expands the donor pool globally. They have a virtual monopoly on this next-generation transport tech.
But having the tech isn't enough, right? You have to actually move the box. And this is where the business model gets so fascinating. They aren't just selling the medical device. They have built their own private airline to transport them.
Which is wild.
Okay.
They now operate a proprietary aviation fleet of 22 aircraft.
And they are expanding that logistics footprint aggressively. They are slated to enter the Italian market in the first half of 2026.
And if they can successfully scale this aviation network globally and become the default infrastructure for all organ transplants, well, that $246 price target actually looks conservative based on the total addressable market.
But there is a massive bear case here, too, and it involves the brutal unit economics of operating a 22-aircraft private airline.
Oh, absolutely.
They are essentially trying to build the FedEx of human organs. But planes need jet fuel, pilots need salaries, and aircraft need constant, expensive maintenance.
And that is exactly where the worst-case scenario takes root. Operating an airline, even a highly specialized life-saving one, exposes you directly to macroeconomic commodity headwinds.
Like rising jet fuel costs.
Yes, which are severely impacting their logistics margins right now.
And that's the mechanism people miss. Every time the geopolitical situation pushes the price of crude oil up 10%, the operating margin on a heart transport flight from New York to California shrinks.
Right. The market is realizing that TransMedics isn't just a high-margin med tech software company. They are a heavy industry logistics company bound by the laws of physics and fuel prices.
It is a profound structural drag on profitability, and it's happening at the exact same time they are ramping up their capital expenditures.
Yeah, the R&D spending required for their new kidney program threatens to weigh heavily on their 2026 profitability.
Because kidneys represent a massive total addressable market, right? Exponentially larger than hearts or lungs.
Yes, but cracking that market requires immense upfront clinical spend.
It sounds like a high-stakes race between the revolutionary potential of their technology and the crushing reality of their rising operational overhead.
That is the defining tension of the stock, and we're going to find out very soon who is winning that race. When you evaluate the outlook, balance the short-term technical noise against this long-term capital intensity, the ultimate catalysts aren't going to be found on a chart.
So what are the real needle movers for 2026?
It will be the clinical results for their enhanced heart and de novo lung trials, which are expected later this year.
Because if those clinical trials succeed, it unequivocally validates the technology, justifies the massive R&D burn rate, and suddenly the jet fuel costs don't look so daunting compared to the incoming revenue from a captured global market.
But on the flip side, if those trials stumble or the FDA pushes back, the overhead of a 22-plane fleet becomes a catastrophic weight on the balance sheet.
Exactly. So to synthesize everything we've unpacked today, TransMedics is a company operating at an extreme structural inflection point. You have a business flashing undeniable operational strength, highlighted by $605 million in revenue and its first full year of positive operating cash flow.
Right, and the stock is currently experiencing a bullish breakout, up nearly 9% today, supported by short-term momentum indicators showing the sellers are exhausted.
But the headwinds are institutional and heavy.
Very heavy. That 9% bullish pop is fighting against a 200-day moving average that remains firmly trapped in a bearish posture.
You have quantitative valuation models that are $100 apart on intrinsic value.
Yep. You have corporate directors taking millions of dollars off the table at the exact resistance levels the stock is trying to approach.
And most importantly, you have a revolutionary logistics model that is highly sensitive to the macro realities of rising jet fuel costs.
It truly is the ultimate battleground stock. And as a final reminder to everyone listening, our deep dive into these sources, the charts, and the conflicting bull and bear mechanics was purely for educational debate.
Absolutely. We are here to help you read the map and understand the economics, but we are not giving financial advice or telling you which path to take.
The market provides the data, the charts provide the psychology, but how you interpret and manage the risk is entirely up to you.
And that brings us to the final piece of the puzzle. You've seen the record operational cash flow, but you've also seen the directors aggressively cashing out at the top. You understand the monopoly potential of the organ care system, but you also see the brutal margin crush of operating a private airline in a volatile oil market. With massive binary clinical trial results looming that could make or break their margins for the next decade, you have to ask yourself, is today's 9% surge the spark that ignites the fundamental run to $246? Or is it just a beautiful technical illusion before the jet fuel bill comes due?